Hello again. In this session, we're going to be talking about investing, spending in Chapter 14, Investing Fundamentals, and then in Chapter 15, starting to talk about investing in stocks themselves. Now, there's all sorts of different kinds of investments that are out there, and we'll be looking at those investments in some of the subsequent chapters here. But one of the things that is important to keep in mind, I believe, is that before you look at investing, that you should generally look at paying off loans first. And the reason is the loans have a particular interest rate associated with those loans, whether it's lower loans, for example, a mortgage, or higher loans like personal loans, and especially high loans like credit cards. Is usually you cannot guarantee in investing that you're going to have a rate of return that's going to be greater than the actual percentage you're paying on those loans. So because you know that you're going to be paying for sure 4, 5, 6, 10% on a loan, rather than investing in something that maybe you might get a higher return, maybe not, is you should focus on paying off the loans first before you are investing. Now, when I talk about investing, I am talking about investing beyond having your safety savings accounts. And again, I have a separate video that I talk about savings itself that is back up as one of the discussion forums. But you should always have liquid cash on hand to be able to take care of the emergencies, the unforeseen events. And so even if those things are sitting in a 90-day CD or other kinds of things, I'm talking about investing which goes beyond that. One of the things that you always want to keep in mind when you talk about investing is how liquid are you? And you want to be sure that you ensure adequate liquidity, which can have a direct impact on what you are investing in. There's type of investments. Money market securities, obviously, we've talked about, are the most liquid kind of investments. There's also stock, and there's common stock versus preferred stock. And just from a terminology standpoint, common stock is that stock issued by a firm to raise funds that represents partial ownership in the firm. Preferred stock is usually something that entitles shareholders to first priority to receive dividends if there are dividends associated with that stock. It also gives preference to preferred stockholders in the event of liquidation of the company itself. In other words, they get their money out of it first before common stockholders. There are primary and secondary markets that are out there for the stock. Primary market is where newly issued securities are traded, IPOs, for example, and those, most of us don't get the opportunity to be involved with an IPO. Usually we're involved in secondary markets where existing markets that are already issued and already out there are traded. And there's different kinds of markets that are out there. Of course, there's New York Stock Exchange, publicly traded exchanges like the New York Stock Exchange or the Amex Stock Exchange. There's other kinds of investments that people might be involved in, including bonds, mutual funds, real estate, all of those kinds of things. And so what I want to do is I want to talk just, the textbook goes into much more detail on those kinds of investments and what they are, but I do want to just talk about investment return itself. And now when we talk about it, don't get too freaked out by the slide and the formula on a slide. But when we talk about returns from investing in stock, those returns come through two ways. Of course, there's price appreciation on the stock itself, and there's also potentially dividends themselves. And you will hear the term growth stock. These are stocks which theoretically have substantial growth opportunities ahead of them. And growth stocks isn't necessarily referring to the company's underlying operations growing. It's referring to the actual value assigned to the stock itself. There's also income stocks that are out there that will provide investors with theoretically potentially large dividends that they'll receive from that. when you're investing in bonds, of course, you're investing and you're getting coupon payments on the bonds themselves, and you're also hoping that there's a bond price appreciation. When you're investing in mutual funds, those mutual funds, you're hoping that the underlying value of the shares within that fund increase, and that when you actually liquidate or sell, that there's capital gains associated with that. Real estate, when you're investing in real estate, obviously you're hoping not only for appreciation in the price of the real estate, but it also may be income associated with the real estate itself. So I want to talk just briefly here of what's on the screen of how you measure the return on your investment. And just real simply, because algebraically it looks a little more complicated than it really is if you want to figure out what your return is, you're always going to take what did I buy that stock at and what did I sell it at. So let's take, for example, that you bought a share of stock for $100 and you sold it for $110. What is the return on that? Well, our formula here is PT, which is $110 is what you sold it for. You subtract $100 from that, and your gain is $10. $10 over the initial purchase price of $100 means that it's 0.10 or a 10% return on that. As you can see here, it's actually relatively simple to calculate. You're just calculating what the appreciation or the gain was over what the basis was that you originally bought. Now, if you want to look at your total return on investment, and if you held a piece of stock that actually paid out a dividend, and you received a dividend during the year, well, it's just going to be, in our example, we had a profit of $10, which was we sold it for $110, bought it for $100, and so we had a profit of $10. But if we also received a $5 dividend during the year, that profit of $10 plus the dividend of $5 is 15, which is a 15% return. So as you can see here, when you're talking about returns themselves, and this basic formula applies to bonds or real estate or any asset that you are investing in. One of the things just to be aware of is that different kinds of underlying assets may have different tax rates associated with the returns. For example, interest payments and coupon payments on loans or on a lot of bonds, they are just taxed as ordinary income. If investments are held for 1 year or less, they're taxed. The capital gains there are taxed as ordinary income. If they're held more than 1 year, they are going to have long-term capital gains treatments. There are some bonds that are out there that are tax exempt or tax reduced, and there's just all sorts of different kinds of investments that, depending upon your personal tax situation, you may be interested in. And this is where a tax counselor can help you to really determine what is the best kind of investment to be involved in. Whenever you're talking about investments, obviously there's a trade-off between the returns that you're going to get on that investment and the underlying risk associated with that investment. And the return risk trade-off among stocks, of course, is for small firms. They tend to have more growth potential, but there's also a higher risk associated with that. There's the risk of whether or not the company is going to succeed operationally. There's a risk that the projections and some of the forecasts may not come to bear, which has additional downward pressure on the stock value itself. IPOs quite often will offer higher returns, but it's also very high risk. A high percentage of IPOs actually become worthless after a period of time. For bonds themselves, large well-known firms have low risk, and usually there's a very low percentage that they pay on those bonds. So there's a low return. Conversely, high-risk companies are going to have higher premiums associated with this. It's important to understand that there's risks that are out there that just has uncertainty because of economic conditions. And because future values of bonds, of actually most investments, are dependent on the demand by investors for that. And we see very much up and down in the kind of investment markets out there. In the mid 2000s decades, last decade, we saw the economy was strong, and so returns were stronger because risk was lower. But as the economy weakened, then we saw things start to turn around where risk was higher, but some of the returns on investments, some of them were higher. So it's just something that you always have to kind of take into account. There's when you look at mutual funds themselves, mutual funds usually contain small stocks or stocks in smaller companies that are more risky than those that have stocks in larger companies. Mutual funds usually will have folded in bonds of weak companies that are more risky than bonds of creditworthy corporations. So again, you just see a lot of these trade-offs, and a lot of it is really what is your stomach for potential loss. There's return risk trade-off among real estate investments, because if you go out there and you buy a rental, obviously you run the risk that renters could default and they stop paying their rent while they're still in your real estate, or they create a significant amount of damage to the property. And if you have to go through having to get them kicked out, that could be an expensive and time-consuming proposition. Also, real estate, there's no guarantees that real estate values would go up, especially with renters, because quite often property gets abused by renters, and so that could actually have an adverse effect on real estate. So again, it's just important for you to understand that you will have different objectives, different stomach for risk, different needs for returns that may help to guide you towards certain kinds of investments. One of the things I do want to mention in closing before we go on to our talking more specifically about stocks is just learning from investment mistakes. You should not make investment decisions based on unrealistic goals. You know, to say when investments out there are, you have a very low tolerance for risk, but you want to have 10% returns on your investment, those two things don't necessarily go together in this kind of economy. So you have to make sure that your goals are realistic. Also, when you talk about investing, you should never, ever borrow money to invest it. As I said at the beginning, if you have loans out there, you should take care of the loans before you invest. Investing should be done with cash that is free and clear. And also, if you have a loss in an investment, don't take greater risk to try to make up for past losses. That's only a recipe for disaster itself. So again, as you go through and you are preparing a personal financial plan, you need to have well thought out what your investment goals are and what you actually can afford, as well as what your risk tolerance is. So let's talk about in Chapter 15, investing in stocks itself. And as I said before, there are different kinds of markets that are out there for you to make these kinds of investments. The American Stock Exchange, there's other regional exchanges in some large cities. There's the New York Stock Exchange, of course, and there's also something called the OTC, or over-the-counter market, which allows you to make trades and bypass brokers sometimes. And there's less stringent requirements than for the New York Stock Exchange for listing on those things. So when you're looking at purchasing and selling stocks, of course, usually you're going to be going through some sort of broker to do that. And a broker can actually talk you through some of the terminology, and the textbook covers some of the terminology as to stop orders and buying stock on margin and short selling stock. And one of these things that I would just say up front is don't get involved in those kinds of transactions unless you have some savvy with respect to the underlying financial aspects of that transaction, because there are risks associated, and investing in stocks is very, very rarely a sure proposition. So let's talk just a few minutes about analyzing stocks themselves. Because obviously when you look at a stock itself, the underlying value of that stock is significantly impacted by the firm's performance. And when a company is doing well, obviously over time the stock price is going to go up, because more people want to get a piece of the action, which means there's less stock available out there. And conversely, when a company is not doing well, that has a tendency to drive the stock value price down. And so for companies that are not early stage type companies, when you talk about analyzing stocks, is the valuation of the stock is quite often based on historical price patterns, as well as what the near-term foreseeable future is going to be. And it's important just to understand the fundamentals, the fundamental characteristics of a company: revenue trends, earnings trends, the sensitivity of the company's performance to economic conditions that are out there. These are all important things. Also, I think an important aspect of it is just how well has a company done with respect to communicating their forecast of what they think is going to happen in the future. For example, if they consistently over the past 5 years have missed sales projections, they've missed earnings projections, then you have a fairly low confidence level that when they put out a projection for next year, that they're going to have the ability to meet whatever those projections are. So those kinds of things become important components. When you're looking at the financial condition of a company, this is why it's important to understand their statement of financial condition or balance sheet, to be able to look at that and see what their source of funds are and how well they have managed the business itself. Income statements, of course, is just understanding what is happening with those kinds of trends themselves. Accounting, that's why it's important to have some basic understanding of accounting, and really what are some of the aspects going into that. Also, just be aware of, have there been incidents of accounting fraud in the past? Have there been some difficulties, readjustments because of misstatements from the past itself? And all of these things are important things to really understand out there. Whenever you're looking at it, of course, you're going to be looking at some macro level things like what's happening with the gross domestic product, the economy as a whole, what's happening with fiscal policy in the United States, which is going to be really kind of having to do with the supply, the money supply that is out there. Are there international concerns whenever there's a war or a potential war? That can have impact on company stock because it can have an impact on the economy as a whole. So inflation, of course, is a major big time factor to take into account. So as you're looking at analyzing stocks, there's just all sorts of factors that can come into play with respect to what could increase or what could decrease a stock price. And obviously, when you are investing, you are trying to bank on the stock price increasing in the future, which means you're going to look at all of the factors in the top part. And if you're starting to get some aspects where, wow, I don't have a stomach for when there's a weak economy, then you basically are probably not going to invest in certain investments that may have the potential of the stock price going down. Obviously, as you can see here, that when investors are expecting somebody to perform poorly, they may be investing in a much more speculative way into the future. And stock prices are going to be very susceptible to movement based upon some of these factors that are going to be going on here. Now, it's just important to understand that there are limitations of stock analysis. Some of it is just in the difficulty of forecasting future conditions. I mean, if people could always do good forecasts, then you wouldn't see the kind of volatility that we see. Also, stock prices usually are, in essence, really reflecting what are considered to be favorable attributes, which may or may not actually turn out to be favorable itself in the future. So when you're talking about investing in stocks, it's important just for you to understand, really, is this something that I should even be a part of? And if I am going to be a part of it, how much of my potential investment portfolio really should I be putting in stocks? And we'll eventually be talking about investment allocation decisions, because this becomes an important part of that. Because some people have the ability to invest in stock and be a little more speculative. Others say, I cannot afford to have any losses. I cannot afford to, in essence, lose it all. And so I'm going to forego the opportunity cost, forego the opportunity cost of potential higher returns by going with something a little bit surer. Until next time.